Have you ever wondered, how do spot CFDs and futures differ, and which one suits your trading style? What's the real cost of trading CFDs? Hello friends, in this in-depth tutorial, we'll answer these questions and more, focusing on a critical aspect of CFD trading, understanding the costs involved. We'll be delving into spreads, commissions, and swaps. So let's jump right into it. All right, CFD trading can be a bit like a puzzle, but we've got your back. Let's begin with spot CFDs and futures. Spot CFDs and futures are like choosing between instant coffee and a 10-year aged wine. One's quick and the other might age you before it pays off. Moving on, first up, we have spot CFDs, also known as cash CFDs. Imagine you're in a bustling market and you can see an apple. You buy it right then and there at the market price, and that's what spot CFDs are like. You can open a trade based on the current cash price, and the cool part is that there's no expiration date to worry about. For example, suppose you're engaged in trading the euro to US dollar currency pair. With spot CFDs, you can buy or sell based on the prevalent market price at that very moment. You can rest assured that there are no concerns regarding expiry dates. Now let's talk about future CFDs. Think of these as a pre-order for the latest gadget. You're not buying it now, you're buying it at a future date. These CFDs allow you to trade based on prices in an underlying market like indices and commodities, but there's a catch. They come with an expiry date. Imagine you're trading CFDs on oil. A futures contract would specify the price of oil for contract expiry at a future date. As the expiration date approaches, the market price may fluctuate. What's the real difference between spot CFDs and future? Trading spot and future is like choosing between instant messaging and sending a letter by carrier pigeon. One's lightning fast, while the other might arrive after the war is over. Well, spot CFDs typically have tighter spreads because they're based on the current market price, which is relatively stable. I don't know what spread is. Well, it's the gap between buying and selling prices. On the other hand, futures often have wider spreads. Why? Because there's more uncertainty about future market conditions. Lastly, the trading style matters. Spot CFDs are a hit for intraday traders, as you have to be aware of swap charges if positions are open overnight. Futures, on the other hand, don't rack up swap charges. They're more suited for traders looking to hold positions for more extended periods. Let's get into spreads, one of those things that can be a bit confusing. Think of spreads as the difference between buying and selling prices at the same given point in time. It's like selling and purchasing a car from a dealership. They quote one price to buy it and another if you want to sell it. The variation between those prices is the spread. So how do we measure spreads? Forex spreads, much like my attempts at gardening, always end up wider than I initially planned. It's like Mother Nature and the market have a secret pact to mess with my expectations. On a serious note, we measure spreads in pips, which are like the tiniest price increments. Here's a real-life example. Imagine you're looking at the euro versus US dollar pair. The ask price is like what you'd pay at a store, and the bid price is what you'd get if you sold the item. The difference? That's the spread. For example, if the euro versus US dollar pair is at 1.07027 and 1.07033, it means that the ask price is 1.07033 and the bid price is 1.07027. So the spread on this trade will be 0.6 pips. But here's the kicker. When we say it's 0.6 pips, it doesn't mean 60 cents. It means $6. You figure that out. You multiply the spread in pips by the pip value, which is $10 for pairs with the US dollar as the quote currency. To determine the dollar value of the spread in pips is multiplied by its pip value. For the currency pairs with USD as its quote currency, the pip value is $10. The size of the spread matters because it directly affects your trading costs. A narrow spread is like getting a good deal on your car trade-in, while a wide spread is like paying more. If you're a frequent trader or a scalper, a narrow spread can help you keep more of your profits. Now, there are two types of spreads: fixed and variable. Fixed spreads remain constant, irrespective of the prevailing market conditions. Variable spreads, on the other hand, can change based on how chaotic or calm the market is. Well, variable spreads can be as unpredictable as my friend's dating life. One moment she's thinking, this is fantastic, and the next she's like, why is everything falling apart? But we love her. Spreads change faster than my phone battery percentage when I'm browsing memes. So what makes spreads change? A bunch of factors. Think of it like weather conditions for trading. Market liquidity, trading times, and big economic events can make spreads wider. It's like how taxi fares surge during a heavy rainstorm. You'll want to be aware of these factors when making your trading decisions. To keep your spread costs in check, the trick is to choose a trustworthy broker offering tight spreads. Also, consider trading when the market is buzzing. That's when spreads are typically tighter. About commission. Commissions are like the service charges at a fancy restaurant. It's the cost of doing business. In CFD trading, brokers charge these fees on each trade you open or close. But do you know different brokers charge different fees? Some might have a fixed fee per trade, while others might have a tiered structure based on how much you trade. So here's a way to keep those commission costs in check. Trade less. No, of course, that is not the right way. The right way is, if you're trading high volume, you might want to talk to your broker and see if they can cut you a deal on the commission. Further, keep an eye out for brokers offering discounts or special rates based on your trading volume. Last but not least, let's talk about swaps. Ever wondered what a swap is? It's the interest you either receive or pay on overnight positions. In Forex trading, a swap is kind of like a financial expedition. While it could lead to discoveries, it might also end with lost treasures. Your money's temporary journey can sometimes lead to a monetary shipwreck. Let's dive into the nitty-gritty of swap calculations. Imagine you're engaged in Forex trading and you make the choice to maintain a position overnight. The interest you earn or owe depends on the direction of your trade and the interest rate difference between the currencies involved. For instance, when the interest rates in the United Kingdom surpass those in America, and you're holding a long position in the Great British Pound to US dollar pair, you can earn interest by rolling over your position to the next day. On the flip side, if you're short on the Great British Pound to US dollar pair, you'll find interest debited when you roll over your position. So how to calculate this swap? It's all about the interest rate difference between the two currencies you're trading. This differential determines whether you'll receive or pay. Now let's get practical. Here's a step-by-step guide on how to calculate swaps on an open position. Step 1, log into your MT4 or MT5 platform. Step 2, right-click on the instrument you want to trade and navigate to Specification. Step 3, under the specifications, locate swap points listed as swap long and swap short. And there you have it. You can now check the swap rates for your specific currency pair. Let's take the GBP USD swap rate as an example. In this case, the trader will receive a credit of $0.032 on keeping a short position open overnight, and he will pay $0.89 as swap charges on keeping a long position open overnight. Triple swaps. So what exactly is triple swap? It's the only thing more confusing than my friend's love life. Once I asked my friend to explain triple swap to me, and I ended up needing therapy. Who knew finance could be so dramatic? But I'll make it simpler for you. It's like a little extra interest charge or credit that comes into play when you hold a position over the weekend. Since the trade ends up being open for 3 nights, swaps applied are 3 times. This accounts for the difference in interest rates during the weekends. Multiple factors influence these swaps, from central bank policies to economic indicators and even geopolitical events. Staying informed about these factors is the key to successful trading. Now let's talk about strategies to manage these costs and make the most out of your trading. Number 1, monitor the economic calendar. Keep a close eye on interest rate announcements and economic events that could impact currency values. Number 2, position sizing. Adjust your positions based on potential overnight financing costs or gains. A little planning goes a long way. Number 3, swap-free accounts. Some brokers offer swap-free accounts. These are a great option if you want to trade without worrying about those swap calculations. And there you have it. In this lesson, we've covered the essential aspects of trading CFDs, focusing on spot versus future CFDs, and analyzing the costs involved in CFD trading, including spreads, commission, and swaps. Stay tuned for our next lessons where we'll continue to explore the world of trading, offering valuable insights and tips to help you become a proficient trader. If you're finding value in this, hit that subscribe button for more pro tips on optimizing your trading strategies.